Today is a brand new day, so let me welcome on board Varun Goyal as well, Kunal Bothra, to talk about what they're making of the market right now. Varun, hi, afternoon. What is it that you've made of this complete U-turn that not just us but the global markets have taken from where we were on Monday to now? Anything that you've changed in terms of a portfolio allocation, or at least recommend doing that?
Good afternoon, Aisha. Thanks for having me on the show. I think if you look at the broader markets, there is no denying that the markets are trading 8 to 10% more expensive than the historical averages. If you look at the Nifty earnings for FY24, we are around 1,000 rupees. We assume 10-12% growth for FY25 and FY26. So if you take 1250 rupees as Nifty earnings for FY26, we are trading at almost 19 and a half times, 1 year forward earnings, and which is 8-10% more expensive than the historical 10-year averages of around 17 to 18 times. So I think broadly, if you look at it, markets are a little expensive, and therefore our preference continues to be present in sectors where there is more surety of earnings growth, whether it's banking, whether it's pharma, whether it's IT, and there's not much that we have changed in the portfolio. As we see the volatility play out in the last 1 week or so. So we continue to be invested in names where we believe there will be good earnings growth for the next 2 to 3 years.
Okay, so you continue to stay invested despite the volatility, but where are you putting the incremental money to work? Which areas, which segments still look okay on a risk-reward basis? Because we're staring at the likes of ABB and Trent, etc. today, wherein the earnings have been strong, but they're not cheap by any yardstick.
Pockets of market which are pretty expensive. I think if you look at the overall industrial and the capital goods space, I know we have seen some of the companies got massively re-rated in the last few years. We would be careful of sectors like defense and railways in the short to medium term. So while defense continues to be a long-term compounding opportunity, but I think the entry-level valuations can come down meaningfully going forward. I think broadly, if you see, we are seeing a healthy earnings growth trajectory as far as the pharma space is concerned. Both the domestic formulations and the CRAMS and API opportunity continues to do well. The US market is seeing better pricing, and therefore we remain positive on that. I think IT also, after the volatility of last 1 year, we believe the BFSI space in North America should do better, and gradually we should see both top line and EBITDA margins coming back. Chemicals is another sector that we believe is turning around after almost 2 years of severe price correction, and we believe that things both on volume and pricing front can get better at this point of time. So these are some of the spaces where we are putting incremental money to go.
Kunal, is today's move decisive enough to say that we're out of the woods, or do you think that come next week we could still see some amount of volatility?
I think we should see more amount of volatility. It's still not been one of the best days in terms of the sector patterns. Yes, the indices have done very well for themselves. We've seen a good 250 point plus recovery for the Nifty and almost 350 plus point recovery for the Bank Nifty. But we are still not out in terms of the resistances. So 24,500, which is the resistance we flagged off 3-4 days back, that still holds on. And even after this gap up move and I would say a bit of a strength from the overall market breadth, we are unable to surpass this resistance, which means that there is a strong amount of selling from the index futures at those higher levels. Even the options data has not changed quite dramatically, because generally when you near a resistance zone, and if the market texture becomes a lot more positive, we expect a change of behavior from the options data, where you see a lot of call writers changing stance and then moving on to put writing stance. We've not seen that change also happening for the index largely. So I think on the back of it, would probably expect the volatility to continue.
Expecting the volatility to continue, but one space which is outperforming today is auto. In fact, not just today, throughout the week, there have been those select names that have been doing well. In fact, let's pull up the weekly chart perhaps of a Tata Motors. Every day since the launch of Curve, that one has been trending higher. Eicher Motor reported good set of numbers. Ola Electric, of course, the latest debutant on the street, is up 20%. Rudra, what is your sense on some of these incumbents, the likes of Tata Motors, Eicher Motors?
Tata Motors has support now at 1,000 rupees for short term, and yes, dips to those levels can be bought, and once it makes a break above those levels of 1,160, a fresh momentum can be seen in Tata Motor. And similarly, if I see the charts of Eicher Motor, again, this is a stock where we have seen some amount of correction which has already come in the counter, and now we are seeing sideways consolidation happening in Eicher Motor. So I would rather wait for some time before I enter into Eicher Motors at current level. might be some more dip to levels closer to that 3% to 5% kind of a correction would be a good entry point. So Tata Motor is a buy at current level. HR after a 3 to 5% kind of a correction will be a good entry level. And I fully agree with Kunal. Let us wait for this break of 24,500 on Nifty and Bank Nifty at 51,000, and that might happen next week. Once we get that confirmation that yes, Nifty has closed decisively above 24,500 and Bank Nifty above 51,000, fresh long positions can be taken, but till then one has to remain cautious and play this volatility with care.
To be cautious, but Varun, I wanted to get a sense from you regarding some of these stock market ancillaries as well, exchanges, etc. MCX today is, of course, reacting to the news flow that there's a new leadership at top, so that ambiguity goes away. NSE reported that latest news flow of 10 crore registered investors, so that's no mean feat. And then obviously earnings came from the likes of NSE and BSE, and for BSE the total revenue jumped up by 149% year on year. The net profit attributable to shareholders was at 265 crore. EBITDA margin expanded to 47% versus 37%, and the total number of transactions for BSE Star MF has also jumped up by 72%. So a lot of these tailwinds for a lot of these stock market ancillaries, would you concur, and what's the best way to play that? Is it through the likes of KFIN, CDSL, etc., exchanges, or maybe some of the AMCs?
Yeah, I think the financialization of savings is going to be a medium to longer term theme. There is no doubt that there is a lot of earnings growth which can happen in this space, whether it's exchanges, whether it's depository participants, whether it's asset management companies. I think as more and more people invest in equity markets, debt markets, some of these intermediaries as well as the market participants will continue to get more business. So I think that is a medium to longer term trend, and we believe that the earnings growth in this space can be ahead of the general economy and the broader market, and as such we would be positive on this space.
Right, okay, that's the view coming in on how NSE and BSE and their numbers as well as the data points have, data metrics rather, have panned out. But one of the star performers from this week is clearly got to be ONGC. Kunal, I want you to come in on the charts. I mean, not just ONGC, look at a Cochin Shipyard. Of course, it's a reaction to its earnings. BHEL has been seeing some sporadic moves. I mean, time and again, the PSU stock theory is actually questioned, but no, they clearly, sort of defy all conjecture.
Well, yeah, I think specific PSU stocks are still finding favor in terms of market trend. So I think NTPC, I think yesterday or day before had seen a good price action. Coal India had seen a similar kind of a price action. So yeah, I think ONGC out of the pack looks attractive even at current levels. 2 days back, if I'm not wrong, the stock had a sharp up move, 6%, 7% uptake. Yesterday was a bit of a subdued move, and today you saw the stock rising up by, I think, a couple of percentage points, at least in the first half. So that indicates that there is a strong follow-through up move, if not immediately, over the next couple of days for many of the PSU names. And this could also set in a point where many of these PSU majors, they could probably come back to their previous highs. I'm not sure about the the entire defense space as such, because there is still some evidence that these stocks are seeing drift on lower volumes, so which means that there is no major participation happening into these names, and that's why I think you see the likes of HAL, BEL, and many of these other names. They are showing signs of a sporadic up move, but then there is nothing meaningful in terms of volume data, which could probably attribute that maybe a bottom could be in place over here.
Okay, sporadic, but nothing structural at the moment. Varun, but do you believe there's a structural change as far as the consumption narrative is concerned? I mean, take a look at Lemon Tree today, down almost, down almost 17% for the week gone by. That is because it reported a weak set of numbers. While on the other hand, the likes of Dabur, Marico, etc., the rural-facing side of things are looking, even GCPL for that matter, looking much better. Would you do a bit of a sector churn there, move from urban discretionary to rural?
Well, I think broadly, if you look at the consumption space, the structural growth rates as far as the staples companies are concerned will be more like high single digit. But if you look at some of the discretionary categories, be it consumer durables, be it alcoholic beverages, be it hospitality and entertainment, I think structurally from a next 3 to 5 year perspective, the growth rates can be higher, and as such, my preference would be to invest in some of those sectors and themes where you can get 12, 15, 17% kind of earnings growth. And I think staples is a space, despite a slight uptick in rural space, that kind of earnings growth might be difficult to come by. So my preference would remain on the discretionary consumption names.
Right, Varun, so good to have you on the show. We'll let you go on that note.
If you like this video, then like, share and subscribe to ET Now.